The question of today's video is, what happens if a 1031 exchange fails? When a 1031 exchange fails, the investor is subject to paying taxes on all capital gains from the sale of the relinquished property, along with depreciation recapture taxes. The IRS typically provides few exemptions or exceptions for taxpayers facing a failed exchange, making it crucial to avoid mistakes in the process. So the next follow-up question is, what are some common mistakes that lead to a failed 1031 exchange? The answer is there are several common mistakes that can result in a failed 1031 exchange. So these including failing to meet the 45-day identification deadline, not clearly identifying replacement properties, or missing the 180-day closing requirement, and taking possession of exchange funds instead of using a qualified intermediary or a qualified escrow to hold it for you. The next sub-question is, are there ways to mitigate the financial consequences of a failed 1031 exchange? Well, while there may be some strategy to defer a portion of capital gain taxes or push tax liability into a following year, success depends on individual circumstances and the specific reasons for the exchange failures. Achieving the full intended tax deferral is often unlikely after a failed exchange. The next sub-question is, how can investors increase the likelihood of a successful 1031 exchange? To enhance the chances of a successful 1031 exchange, investors should assemble a team of experienced professionals, including tax and legal advisors, a qualified intermediary, and possible real estate and investment professional. Additionally, accredited investors might consider identifying a Delaware statutory trust DST as backup replacement property to avoid missing critical deadlines. So in this course, there's a whole section on DST, so feel free to check that out. I hope you liked this video. Let's move on to the next one.